Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning, today on Tuesday because of the holiday, but with the stocks to watch and the stock market news you need to see. And despite that shortened week, this could be the most important week of the year for stocks. What happens this week could set the direction for the entire year, whether we see another 20% plus year or whether we see that beautiful bull market come crashing down. In fact, this week I'm going straight to the stocks to watch, including updates to AMD, Netflix, and quantum stocks like Rigetti Computing. Then we'll talk about the big news this week, earnings that will be hugely supportive of stocks, but also how to watch what President Trump does this week to know exactly how to invest the rest of the year. That is an insane amount of potential news, so let's get started with the stocks I'm watching this week. And Advanced Micro Devices, ticker AMD. And the company doesn't report earnings until February 4th, but could find support leading up to that date. And the more I dig into the stock, the more I like. Shares dropped 13% in December alone on downgrades from Goldman Sachs, KeyBank, and HSBC, weakness in that PC and the gaming market, along with Nvidia's unstoppable dominance in AI. Despite that pessimism and the 23% plunge over the last year, Wall Street analysts have an average price target of $172 a share, 41% higher from here, and news could turn that positive very quickly. The company had some strong presentations at the recent CES in Las Vegas and could report an upside surprise during its February 4th earnings. AMD has been taking share in the PC and gaming market from Intel all year long, especially following its disastrous Arrow Lake chip. In fact, AMD has reported shortages of its Ryzen 7 because demand has been so strong. Now, I'm going to outline some potential surprises next, but revenue is already expected up 25% this year to $32 billion, with earnings to jump 54% to over $5 a share. Now that puts the shares at a price of just 6 times this year's expected sales, a 95% discount to the 11.7 times average it's traded at over the last 4 quarters, and a 23 times price to forward earnings valuation, also a huge discount to where it usually trades. So here you've got a stock in the biggest growth market, admittedly the runner-up, but still extremely strong growth, trading for at least a 30 to 50% discount on its price. And I think we see that sales growth ramp up even faster than expected. That's because AI is now shifting from model training, which uses an immense amount of compute power, to a less intensive inference stage. Nvidia has dominated the chip market for its AI training for its advantages in edge computing, but the shortages, along with rumored overheating problems in its new Blackwell chips, has pushed those prices skyward. Nvidia GPUs cost upwards of $25,000 each, and we're hearing lately of a lot of these hyperscalers shifting to AMD for its less expensive chips. Nvidia's 300 series, especially the 350 upgrade launching later this year, which will feature a 35x performance increase, are very competitive with Nvidia's earlier Hopper 100 chips on those inference benchmarks. Also, Dell recently announced it would be using AMD chips for corporate customers for the first time, where it previously only used AMD for consumer PCs. IBM has also said that it would be using the AMD 300 series in its cloud services starting the first half of this year. And I think little or none of this potential upside in AI is built into the price at this valuation, so we could see those shares of AMD rise even further than the analyst target of $172 a share. We're just getting started here, but if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by investors and for investors. I just started using it late last year and love the app for getting ideas and sharing my portfolio. And this isn't just another investing app though. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and the average dividend yield across the entire group. You'll also be able to join more than 200,000 investors in the social feed to see what everyone else is talking about. Now, I've shared my portfolio on the app, and it's totally free to download, so look for the special invite link I'll leave in the description below. Alibaba Holdings, ticker BABA, has suffered along with the other Chinese stocks ahead of a potential trade war and is now down 30% from that October jump to $120 a share. This was one of my biggest winners last year, up $120,000 on the call options, and the shares are back into that deep value territory. Revenue is only expected up 6% this year, but ignores some upside surprises, and even on this roughly $140 billion in expected revenue, that puts the shares at just 1.4 times on a price to sales valuation, a 35% discount to where it traded late last year, and at least a 20% discount to fair value. We'll see how far President Trump goes with his tariffs starting this week, but reports are out that China is planning a very big stimulus offset. Beyond those economic measures that could boost consumer spending, the government is also likely to buy stocks directly through its stabilization fund that could reach into the hundreds of billions of dollars. Those short-term measures, or just a more nuanced tariff strategy here in the US, could boost those shares quickly, but the company also has a lot of long-term levers for growth. Alibaba's open-source AI model, Qwen72B, has produced performance comparable to Alphabet and Anthropic's models, and its cloud business could get a boost from increased data center usage around AI. Alibaba has also been aggressively pricing its cloud services, which could help beat on the top-line revenue growth, even if it does detract a little bit from earnings. Also going to be watching this week, Netflix Inc., ticker NFLX, going to be reporting its earnings after the close on Tuesday, with the shares up 79% over the last year. I recommended the stock in August at $700 a share on the run-up to its promotion for that second season of its hit Squid Games that was released December 26th. But gotta tell ya, sold it the first chance I got after binging those 6 episodes. Netflix is unquestionably the dominant player in streaming, and the addition of sports will be additive to subscribers, but that dumpster fire of a Squid Games is not gonna keep people from canceling the subscriptions, and I wonder if the high price that the company is paying for those sports licenses is going to detract more from expected than earnings. Earnings for the quarter are expected to double from last year, but to slow to just 12% for the next quarter and 20% for the full year on 12% earnings growth. Now that doesn't necessarily make the shares too expensive at 36 times on a price to expected earnings basis, or just over 8 times on expected revenues versus some of these historical averages, but the stock does have a nasty habit of volatility around its earnings. It's fallen in 6 of the last quarters, with an average drop of 13% when it disappoints. And that's versus an upside of 11% in the 6 quarters it did outperform. The fourth quarter has seen a positive surprise in 2 of the last 3 years, but investors should note here that the upcoming first quarter report in May is nearly always bad, with missed subscriber goals as people cancel after the holidays. I highlighted bank stocks last week as a strong buy before their earnings, with the Spider Bank ETF, ticker KBE, up nearly 8% when those earnings came in. And favorites JP Morgan, ticker JPM, and Goldman Sachs, GS, were up even more, just over 8 and 11% on the week. But there is a warning here that we're seeing that it could be a very good year for banks, that not all banks are created equal. From the earnings reported, we're seeing an optimistic outlook on investment banking, market activities, and mergers and acquisitions ahead of that deregulatory push promised by Trump. Now, these are the kinds of high finance bankings that were up 25% to $10.9 billion for JP Morgan in the quarter. Conversely, though, we're also seeing weakness in the lending and what's called the net interest margin, that difference between what banks charge on their loans and what they pay on deposits. Loan growth has stagnated over the last few months on a sluggish economy, and fewer Fed rate cuts now expected means higher rates banks are going to have to pay on those deposits. Net interest income was actually down 2.3% and more than $500 million for JP Morgan last quarter. So what we could see here is that those Wall Street banks like Goldman, JP Morgan, and BlackRock, which is the largest issuer of ETFs in the world, reporting a record $20 billion in fund assets, should all continue to do really well and then leverage that market mood for those more bucks. Regional banks, though, that do most of their revenue from lending and that net interest income could underperform, so you might want to avoid those in favor of those majors. Ally Financial, ticker ALLY, though, would be an exception to this, a consumer-focused bank that I'm still buying on good growth and great valuation. The online bank reports earnings Wednesday, with earnings expected up 28% to 58 cents a share, despite a little bit of weakness in revenue. Now, last year's revenue and earnings took a bit of a hit on the weak car lending market, but are expected to bounce back this year with 37% earnings growth to $4 a share on an 8% revenue growth. I've been adding shares here since October after the stock plunged following its last earnings report, but its valuation is just too cheap to ignore here. Besides trading at just 9 times that expected earnings, the shares are priced at just 0.9 times book value, which is at least 14% below fair value on top of the 3% dividend yield. Against all this, Ally is a solid fintech, and while auto lending is still its bread and butter, it also has the largest digital bank with a growing business in insurance, credit cards, and home loans. Warren Buffett owns nearly 10% of the bank through his Berkshire Hathaway portfolio, a position worth over $1 billion on 29 million shares. Symbotic Inc., ticker SYM, jumped 16% last week and is up over 18% since we started talking about it in early December. Last week's bump was on news that Symbotic would acquire Walmart's advanced systems and robotics business, which pretty much cements that Symbotic as the AI logistics company to own. Now, the background here is Symbotic is using AI-powered robotics and software to automate warehouse and logistics with a 4-year development partnership alongside Walmart that alone could send revenue booming higher. Here, just installing its robotic systems in warehouse operations is a $432 billion market, with the operational side another $500 billion. So what we have here is an evolutionary step in that trillion-dollar warehousing industry, a leader in the space that is already operating warehouses for Walmart, Target, and Albertsons, and all with the backing of Walmart, which owns 14.5% of Symbotic. But why the robotics news with Walmart is so important, and I believe could make this a $250 billion company, which would be a 1,500% return or more, is now with the robotic systems acquisition, it puts Symbotic in a position to operate Walmart's 210 global distribution centers and dominate that trillion-dollar warehouse market. The agreement tasks Symbotic to develop, build, and deploy an automated system in delivery, so not only warehouse operations, but also delivery for the world's largest retailer. Now in this, Symbotic already has a revenue backlog of $23 billion, with the deal expected to increase that by another $5 billion. And remember, this is a company expected to post just $2.3 billion in revenue this year, so this could keep those sales growing at that 30% plus range for years. Now I'm loading up here because one of two things happens. Either Walmart expands this partnership to the point where it just buys that remaining 86% of Symbotic that it doesn't own, or the company revolutionizes the warehouse market with its AI and robotics. Also watching quantum computing stocks, which were down 20% since my tough love lesson in the December video, but now may have some momentum that could make for a short-term play for investors willing to take a lot of risk. Now my previous video pointed out that stocks like Rigetti Computing, D-Wave Quantum, and INX may change the world, but that quantum revolution would take years longer than investors would want to wait. NVIDIA CEO Jensen Huang recently echoed that point, saying that the technology was still decades away, and Meta Zuckerberg reiterated again last week, sending the stocks down further. My point here, folks, was that yes, these stocks have surged higher, but at what cost? If you're not ready to see a 40% crash on any single day and just shrug it off, then these are not for you. But then two announcements last week could support those quantum stocks for investors willing to take that risk and the trade. NVIDIA announced a special quantum day for its March GTC conference, where I imagine the CEO is going to be much more open to the technology. Microsoft also announced last week that it would institute a training program to help businesses be quantum ready. These stocks are still not for the faint of heart, but especially around that March GTC date, could be a very good trade on news at the conference. Giving you that bigger picture here with the Sector Spiders sector tracker. All 11 stock sectors closed higher last week with impressive strength in most, including gains of more than 4% in 6 groups: utilities, real estate, materials, industrials, financials, and energy. Now the rebound in utilities and real estate were really driven by that drop in interest rates and may not continue unless we see a change in market expectations. Energy and financials have already been bid up over the past month, but some upside might remain in those financials group for the big banks. Of last week's winners, though, materials and industrials look like they could continue higher on attractive valuations and that momentum. Consumer discretionary stocks are starting the year off on a weak note, down 4.3% over the past month, and the second worst sector after consumer staples. Before you go looking to buy the dip, though, pay attention to what bank earnings are saying about consumer credit and lending. Now we know that lower-end consumers are already stretched, and overall consumer spending is losing some of its momentum. If bank earnings confirm this for the holiday quarter, I think they will. We could see more weakness in those consumer-related stocks. Looking at the news this week, and a very important tell for the rest of the year, President Trump will be sworn in while the market is closed on Monday, so that means Tuesday's market is going to be a very important measure of investor sentiment around those early executive orders. While earnings are just starting to heat up and should be very supportive, the flurry of first-week policy announcements is going to set that market mood. And as we've been talking about lately, this is all about the timing. Trump and Treasury Secretary nominee Bessent may be talking up tax cuts as a priority, but the reality is a very thin majority in Congress means Republicans are going to struggle to extend those expiring tax cuts, much less pass new tax cuts. That's going to weigh on the markets as that reality seeps in and we get closer to that tax cut expirations at the end of the year. A deregulation is another market positive, but it's going to be hard-fought tooth and nail through Congress. On the other hand, some of those market-unfriendly policies could be enacted much more quickly with a presidential order. Here is where we need to see a slower or gradual reality versus some of the bombastic promises made on the campaign trail. If we do see the biggest mass deportation in history on day one, including immigration raids at businesses, the market is going to be punished on fears of higher inflation and a shrinking workforce. Now, on day one, if also we see it through an executive order, we see an expansion of tariffs to 60% on Chinese goods, 25% on Canada and Mexico, and maybe 20% on all imports. stocks are going to crumble on fears of inflation and that out-of-control trade war. Of course, President Trump knows this, and there's already talk of a gradual system of tariff increases from 2 to 5% a month. Also, deportation plans may seem to have been tempered with reports of an initial focus on those with criminal records. If Trump can find a way to appear like he's keeping his campaign promises and being tough on the issues at the same time without spooking the market, we will continue to see stocks rally, but all of this should become very evident within the first 2 weeks of this administration. If the market doesn't like what it sees in this early priorities, we could see a continuation of the 10% correction we started in December. Join me on the Blossom Investing app and see the stocks everyone is talking about, including what's in my portfolio. The app is totally free to download, so look for that special invite link below, or click on the video to the right to see the 7 penny stocks I'm buying for 2025. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.